A currency collapse signifies a widespread loss of confidence in a nation's money, leading to hyperinflation, significant devaluation, or rejection in international transactions. This loss of confidence can manifest as hyperinflation, where prices rise dramatically, significant devaluation against other currencies, or outright rejection in international transactions. It's more than just a drop in value, it's a fundamental breakdown in trust that undermines the currency's very foundation. Currencies derive their value from government backing, economic stability, and their usefulness in facilitating trade. Without this trust, individuals and nations begin hoarding foreign currencies or assets, which can trigger bank runs and broader economic contraction. Historical examples illustrate this vividly. In Weimar Germany during the 1920s, hyperinflation rendered the currency virtually worthless. Similarly, Zimbabwe experienced hyperinflation in the 2000s, where astronomical denominations were printed to keep pace with rising prices. The effects extend beyond money itself, leading to shortages and economic hardship, as seen in empty supermarket shelves during periods of severe inflation. Such collapses create widespread financial distress, with people and institutions facing panic and uncertainty. Since the 1944 Bretton Woods Agreement, the U.S. dollar has been the world's dominant reserve currency. This historic accord established the framework for international monetary cooperation after World War II. As of 2026, the U.S. dollar holds about 58% of global foreign exchange reserves, making it the most trusted store of value worldwide. It is also used in 88% of global trade invoices, facilitating international commerce. This status allows the U.S. to serve as a safe haven asset during global uncertainties. Moreover, it provides significant benefits, including low borrowing costs, as the U.S. can issue debt in its own currency without facing immediate repayment pressures. Global trade relies heavily on the U.S. dollar, which facilitates the vast majority of commodity transactions worldwide. This dependence creates stability but also vulnerabilities. A key example is the petrodollar system, centered on oil trade. Oil producers receive U.S. dollars for their exports and reinvest those earnings into U.S. assets, such as bonds and treasury securities. This creates a cycle that strengthens the dollar's global dominance. Beyond oil, the dollar is used in most commodity trades, providing predictability and stability. Countries borrow in U.S. dollars to finance development and settle international transactions in USD, reducing exchange rate risks. Without the U.S. dollar's role, global trade could fragment into regional blocs, leading to higher costs and increased volatility. This interconnected system highlights the dollar's foundational role in international commerce. A collapse of the U.S. dollar would severely disrupt international trade. Contracts denominated in dollars would become difficult to fulfill, potentially freezing global commerce. Oil trade, a cornerstone of global commerce, could shift to less stable alternatives, causing gas prices to spike dramatically and further disrupting supply chains. Developing countries heavily indebted in dollars would face defaults, leading to famine and unrest as savings lose value and loans become unaffordable. A loss of global confidence in the U.S. dollar could spark capital flight, where foreign investors rapidly withdraw their investments from the United States. This sudden outflow of capital would weaken the dollar's value, potentially driving inflation to extreme levels, with historical parallels suggesting rates as high as 50% annually in severe scenarios. Servicing the U.S. national debt would become far more expensive. Currently, foreign investors hold approximately 30% of U.S. debt securities. If confidence evaporates, these investors might dump their holdings, causing bond yields to spike and dramatically increasing the cost of borrowing for the U.S. government. The consequences could be severe, potentially requiring higher taxes to cover these elevated costs, cuts to essential government programs, or in extreme cases, defaulting on portions of the debt. This scenario would create a vicious cycle, further destabilizing the economy and exacerbating the inflationary spiral. In summary, the implications for U.S. inflation and national debt would be profound, creating significant challenges for economic stability and fiscal policy. Potential replacement currencies for the US dollar include the euro and the yuan. While these currencies have gained influence, neither currently matches the dollar's global dominance in market depth and widespread acceptance. The euro holds about 20% of global foreign exchange reserves. It serves as the primary currency for the European Union and is widely used in European trade and financial transactions. The Chinese yuan, also known as the renminbi, has been gaining prominence through expanded Asian trade initiatives. Its share in global payments has risen significantly, particularly in China's economic sphere. Comparing market depth, the US dollar dominates with 58% of global reserves and 88% of international trade settlements. The euro holds 20% of reserves but is primarily regional. The yuan is expanding, but still lacks the broad global acceptance needed for full replacement. For any currency to fully replace the dollar, it must offer comparable market depth, economic stability, and global trust. While the euro and yuan are strengthening, a complete transition would require significant changes in U.S. influence and global economic dynamics. A complete U.S. dollar collapse in the near term is unlikely due to its inertia and the strength of the U.S. economy and military. However, a confluence of factors like war, policy failures, or hyperinflation could trigger a collapse. Trends indicate a gradual erosion of USD dominance rather than a sudden collapse, with a potential shift towards a multi-reserve currency world. Potential future scenarios include a sudden collapse with low likelihood, gradual decline over years with moderate likelihood, and a multi-reserve world with high likelihood.